Many investors choose gold for its safe haven reputation and belief in long-term price appreciation. Beyond simply buying and waiting, you can maintain gold exposure while generating steady income through covered calls on GLD, SPDR Gold Trust, the world's largest gold ETF. First, you buy GLD shares to track the price of physical gold without storage hassles. Suppose you hold 1,000 GLD shares, roughly 1 ounce per share. Each month, you sell call options with strikes above the current market price and 1-month expiration. Option buyers pay you a premium, which you keep as income. How it plays out: price rises above the strike. Your calls may be assigned. You sell 1,000 GLD shares at the strike, locking in both capital gains and the premium. To stay exposed, you roll up, close the old call, and sell a new one with a higher strike the next month. Price falls below the strike. The calls expire worthless, so you keep your GLD shares, even at a loss, while the premium cushions the decline. You can also roll down, close the original call, and sell a new one with a lower strike and higher premium to boost cash flow. Price remains flat. Calls expire worthless. Your GLD position stays intact, and you collect the premium, effectively adding a yield similar to a bond coupon. By writing monthly covered calls and rolling up when gold rallies or rolling down when it weakens, you blend potential capital gains, downside buffers, and consistent income. Rolling up raises profit targets. Rolling down maximizes premium in a weak market. Key considerations: GLD option bid-ask spreads affect net income. Writing covered calls requires sufficient margin or capital. Ensure adequate GLD option liquidity for your trade size. Overall, covered calls on GLD, with strategic rolling up and down, offer an elegant way to own gold while earning monthly income. This approach adds flexibility and higher potential returns versus a simple buy and hold strategy.